Family employment is not a parenting lesson. It is a business structure, real work, reasonable pay, clean records, and a family economy built around responsibility, capital, and long-term thinking. When the structure is real, the child gains more than a paycheck. The business becomes a practical place to learn how work, money, and ownership fit together. The order matters. Start with work the business already needs. Match that work to the child's age, maturity, and supervision. Document the role. Then pay for work that was actually performed. Only after those pieces are in place should the family consider tax treatment, saving, investing, or debt goals. The lesson is a side effect of the job. It is not a substitute for it. The SHARE framework connects family employment to the larger purpose. S is for sire. Who does this structure fit? H is for hire. How does legitimate family employment work? A is for acquire. What can earned income build? R is for retire. How can reclaimed cash flow support debt reduction? E is for empire. What knowledge, habits, and systems can continue into the next generation? 5 questions. 1. Family economy. Start with the task, not an impressive job title. Younger children may organize supplies, sort materials, or help with light cleanup after business activity. Older children may scan receipts, package orders, update trackers, or prepare content folders. Teenagers may support data entry, inventory, scheduling, or draft customer communication. The role can grow with the child. The standard does not change. The task must serve a real business purpose, fit the child's abilities, and receive appropriate supervision. 4 parts make the employment structure believable. 1. Real work, tied to a business need. 2. A written job description with defined duties and supervision. 3. A reasonable wage supported by outside benchmarks, not a number chosen because it is convenient. 4. Clean records showing when the work happened, what was completed, and how the child was paid. This is the operator's standard. If the records cannot show it, the claim should not be made. Most problems begin with shortcuts. A made-up job, vague duties, adult-level responsibilities assigned to a young child, random cash with no payroll trail, missing time records, or tax and labor rules guessed from something read online. The test is simple. Would this role, wage, and record survive ordinary scrutiny? If the answer is unclear, stop and correct the structure before money moves. Saying no to a weak setup protects the child, the business, and the family. A is for acquire assets. Every business owner sees payroll as money going out. With family employment, the dollar can remain inside the family economy. It changes seats. Earned income can support age-appropriate spending, saving, giving, investing, or future business capital. It may also create access to accounts that require earned income, subject to the rules of those accounts. The important shift is not the account itself. It is that the child begins making real decisions with money that came from real work. One legitimate employment structure can support 4 outcomes. Tax deduction. Wages for real work may become a business expense when handled correctly. Asset growth. Earned income can become the child's capital earlier in life. Debt reduction. Improved family cash flow can be given a specific job instead of disappearing into spending. Legacy. The child gains experience with work, records, money, and ownership. The family economy is the outcome. The paycheck is the mechanism. R is for retire debt. Family employment does not erase debt, and a child should not be made responsible for adult obligations. The principle is about direction. When legitimate wages, deductions, and household choices improve available cash flow, the family can decide what those reclaimed dollars should do. Some may support the child, some may strengthen reserves, some may be directed toward principal under a separate debt strategy. Extra money helps. Aimed money changes a plan. E is for establish empire. Empire does not mean a larger company or a child forced to inherit a business. It means a family that operates with shared knowledge and durable systems. The life skills path builds responsibility, confidence, communication, and follow-through. The legacy path adds exposure to operations, decision-making, and ownership thinking. Both are valuable. The child receives options rather than an assigned destiny. Entrepreneurs raise entrepreneurs by giving children real exposure with real standards, while the stakes are still manageable. S is for sire, and it begins with fit. Not every family or business qualifies for the same treatment. The child's age matters. The business entity and tax classification matter. The work and state rules matter. Before implementation, answer 4 questions. Is the business structure eligible? What work is age appropriate? Which outcome matters first? And what records need attention? A responsible process disqualifies weak fits early instead of bending the rules to create a sale. Visit hirethekids.com and take the free 4 outcomes assessment. It helps determine whether the structure fits the business, the child, and the family's goals. This video provides general education, not tax, legal, payroll, or investment advice. Requirements depend on the business structure, tax classification, state, child's age, and work performed. Review the arrangement with qualified professionals before implementation. Hire the Kids. Entrepreneurs raise entrepreneurs.